Hi guys, welcome to our weekly trading idea. Today is another historical day in the financial market history. Gold just climbed to a new record high at 1944, breaking the 2011 all-time high near 1920 as you can see here. Also, the Forex market has been very trending with the US dollar melting down for the 7th day in a row as you can see here. And of course, as a result, the main currencies traded higher against the greenback, especially the euro, reaching September 2018's high. If you remember, last week we were expecting this huge rally in euro due to the EU stimulus package. First target was 1.15 and second one was at the monthly trend near 1.17. Today we will explain why the USD is not appealing for investors nowadays, along with a technical analysis study on the dollar index on all time frames. Uncertainty about what happens in the US economy after the extra $600 unemployment benefit expire drove the investors out of the US dollar. The US government is struggling to get control of the COVID-19 outbreak in the US. It's even worse because they did not agree yet on an effective stimulus package too. On the other hand, European leaders put their difference aside and came up with a very powerful stimulus package that will boost the Eurozone's recovery. You can see the USD weakness obvious on the gold strength. Checking the gold monthly chart, back in 2011, after the financial crisis and after the huge QE from the Fed to recover the economy, gold climbed to its previous all-time high, and now history is repeating itself this time with much worse and uncertain conditions. So we won't be surprised if gold surpassed $2,000 for an ounce. This week is also not encouraging for the USD. The extra job benefits will disappear, and as you can see, the GDP is scheduled for release. And anything above 40% will be a shock for the markets that could send equities and currencies plunging lower. Last but not least, we have the Federal Reserve meeting on Wednesday, which is also expected to be more dovish than the past meeting. So let's check the chart. On the weekly time frame, this is a bullish trend since 2011. We are now at a very critical level near 94. This is a 61.8 from the up move. As you can see, we are testing it now. So this is an intersection between trend support and 61.8. A breakout for this level will be very dangerous for the USD. Jumping to the daily chart. Last time we took the Elliott wave from this level. Let's take it from the top. Let's say this is an Elliott wave. It could be 3, 4, and maybe then 5. Or even it could be this 3, 4, and now 5. Both cases, for now, we don't have a confirmation or a sign for a rejection or a bullish movement in the USD. So we'll be watching the weekly close at this level, and a break on the weekly chart for this level, it could lead for continuation for the sell-off. Just a reminder, this big pattern could be a double top or rectangle. So a break for this level could easily lead to a drop for February 2018 low near 88.7. So that was it for me this week. Thank you guys for listening, and I will see you next Monday.